Good morning, I'm Chris Beach, and welcome to Charts the Markets on IG Live. And the losses continue across equity markets as risk-off moves remain dominant. Rise in oil prices, so much so now that inventory levels are becoming quite the concern. An increase in demand there, of course, driving that. And also that increasing surge in global bond yields, particularly in the US, has really made for a very difficult week, a very difficult month for equity markets. There's no sign of the selling abating as we head towards the last few days of September and the beginning of Q4. It is the rise in oil prices that's really driving a lot of this, because it then means that we expect perhaps inflation to continue to revive into the end of this year and maybe beyond. And last week's Fed meeting really set the seal on it. The fact that inflation, interest rates rather, would remain at elevated levels until we think, our current expectations at least, until September of next year. The Fed expects to leave rates precisely where they are for a very extended period. A lot of 2023's rally was based on, well, partly based on hopes that the Fed would have to cut at some point, first by the end of this year, and that's not going to happen now, so early in 2024. Neither of those things is going to come to pass, it seems, on current evidence. Of course, we had more good data yesterday from durable goods in the US, really coming in above expectations, and that meant, of course, the good news is still, if you like, bad news for equity markets, because it means the economy is still solid. There's no reason for the Fed to think about cutting rates. And as a result, we've seen losses in stocks again overnight. In Asia, we had more declines. Chinese stocks coming under particular pressure, particularly those focused on China, really signs of weakness coming through there again as government stimulus hopes fade. The other thing to bear in mind is that, of course, you've seen Japan really affected by the rising dollar-yen figure, and that's going to make life interesting for FX markets, really, as we head into Q4. Otherwise, aside from oil prices, gold still coming under pressure as well because of that rising US dollar. So starting with the indices, let's start with the Dow this morning, currently trading down at 33,487, and that's off the lows seen on Wednesday. We did have a bit of a late rebound for US markets after heavy losses on Tuesday. They managed to recoup some ground on Wednesday. But as you can see here, we're now eating into those that recovery once again in early trading today. So we're dropping just below 33,500 once more, and that's back at its lowest level since the early days of June. We did hit the lowest level since the 2nd of June in yesterday's session. So MACD continuing to decline. Stochastics rolling over once again from already low levels. That indicates, of course, firm bearish momentum. It's not a sign that we're going to get any kind of rebound. So the price action doesn't support that view either. So the next target for that takes us down to 32,700. Really, the more broader view. The key things to watch down here, where we last were at the end of May, where the Dow then managed to rally off the 200-day moving average. The difference between now and then, of course, is that we're now firmly below 200-day moving average. So rather different performance shaping up here for the Dow. We're not suggesting we'll go all the way there, but certainly at the moment there isn't much sign of any buyers coming in to rescue this. The buyers would want to see, I think, back above this support zone from early June, end of June, early July, around 33,600, and then back above the 200-day moving average might provide some stabilization. Tech stocks, of course, still very much in focus. Now, this is the key one. It's been such a good year for tech, or it was at least until about the middle of June, where we essentially didn't go anywhere from there. We've now dropped below those levels. We are testing once again this low from the middle of August at 14,553. We briefly dropped below yesterday, didn't close below it. So very much all eyes on this today. Get a close below that level, and that amplifies the negative view as well and takes us on down to 13,700 maybe. That's a bit of a gap until the next one, next big support level to look out for. And of course, you've got that rising 200-day moving average. We're not suggesting it will go there immediately, or indeed we'll get there, but certainly that's just the next level we are looking for. It's certainly an interesting development, of course, that you now have the Nasdaq really having established that lower high in August and September, now breaking below the August lows to create a possible lower low, if only just. So watching that one very closely as well. No sign, again, in indices generally, that we're seeing any kind of rebound in the shortest time range. We thought we had that with the Nasdaq at the end of last week. Thursday, disappointing session, but Friday, a bit of a recovery into Monday. that lasted about 24 hours, and then back down again on Tuesday. So really coming under pressure there. Back over to Europe and just to look at the French index, the CAC 40 as well. This one, of course, not a great performer over the last 5 or 6 months, because from hitting a peak in April, it's then really just wilted. Support zone around 7,100 was holding back any further downside, but we're now below that. So what was previously support becomes potential resistance. So the index down at 7,050. So that takes us on now to the March lows, remarkably, 69.24. That would still leave, just to put things in context, because I do like a bit of context, down from where we were back in October. Even if we got back to 6,900, we're still up 23% for that past 12 months. It's still a very, very solid performance. It's just this consolidation of European stocks has gone on longer than people thought, and indeed is turning into something probably more than just a simple consolidation. You can see that there in the CAC, really. What was a fairly tight range-bound trade between 7,100 and about 7,400 is now broken to the downside. Clearly an ominous signal. FX market seen a bit of a respite for euro dollar in early trading. Dollar weakening off just ever so slightly, with the euro gaining some ground back above 105. And so we now find ourselves remarkably within the space of 3 months back at levels we last saw in January and indeed March, around the 105. So just below. So that's a key area of support potentially developing. We'll see whether it can hold in a similar fashion to what it did back in January and February and March. Of course, then, as if we need to say it, we were above the 50-day and indeed above the 100-day moving averages and firmly above the 200-day. None of those things is the case now. So while that doesn't mean you can't bounce from here, it is perhaps a slightly different view if you're looking at it from more of a trend perspective. And indeed, we have on the cusp of today and tomorrow, maybe into next week, the dreaded death cross in euro dollar, the 50-day moving average plunging towards the 200-day moving average. Of course, and moving averages are always reflective of what has happened. So while we did, if you look back to December, see euro dollar push higher in the wake of the golden cross we had there, it then did have an eventual pullback. It's possible that we have some kind of retracement in the short term for euro dollar in the wake of the death cross. I always think death cross is far more exciting a term than golden cross, but sounds perhaps more ominous than it should be. It doesn't mean that we can't recover from here, but it certainly does maybe invite a change of view, perhaps is the best way to put it. Nonetheless, if you look at euro dollar, trend line resistance from that July high comes into play around 106.70, so that could cap upside in the short term. Over to the euro against the pound, really coming under a bit of pressure this morning, but after the week the pound's had, it's perhaps not surprising to see at least some relief for the UK currency. But quite overstretched in the short term, perhaps after the strong gains for September, thus far as the pound is having another September to forget just a year after the last one. Dropping back towards possible trend line support here and the 50 and 100-day moving averages. So that's something to bear in mind. That this pullback just sort of pair a little bit overstretched near the 200-day moving average, which is taking off some of the froth in the rally before potentially moving higher again. I think a lot of buyers would view a bounce off the 86 zone as a very positive development. Might put us back in frame for a move back towards the 200-day moving average. To close below 85.80 might then suggest the trend line support has been broken and could open the way back down to these lows that we saw during the course of July, August, and indeed into September. Aussie dollar supported a little bit. Yesterday's CPI reading maybe we'd see more sustained rebound here, but it's just one day so far. Again, taking a beating over the past 2 or 3 months, so maybe we are due some kind of short-term recovery. Although, as you note here, you've got daily MACD rolling over, or on the cusp of rolling over once again for the first time there since late July, really. So the sellers appear to have momentum firmly on their side, at least on the daily time frame, even if it is perhaps slightly overstretched to the downside. Nonetheless, the declining 50-day moving average does really send the message that the short-term trend is still firmly down, even if due some kind of short-term recovery. Anything that rallies back towards 65 but doesn't get back above it is a fresh bearish signal, which mirrors what we'd had in the course of August and September. Commodity markets, gold, unsurprisingly, not liking the current environment of a rising dollar and rising bond yields because it certainly takes the shine off gold, pun very much intended there. Crucially, we're below and closing below that support from the end of August, or the low from the end of August anyway. So that's another negative development here for gold. And that then, once again, takes us on looking back towards the February and March lows and 1806. We have our death cross in gold as well, the 50-day now below the 200-day for the first time this year. I'm sorry, the first time since the very beginning of January this year when it managed to cross above it. So again, another potential change in the dominant narrative here. What was interesting with gold last week is that you had that rally toward trendline resistance, then also failed the 50-day moving average, and then it collapsed. So the sellers firmly in charge here. Although in the short term, maybe some consolidation could result, but I think we'd have to sit back above 1920 at least to suggest that maybe some kind of decent recovery is in play. And from commodity that keeps going down to one that keeps going up, oil prices, incredibly, we reached the highs we saw in October and November of last year for WTI. Indeed, this morning, early trading, we have moved to the highest level here for oil prices for WTI since the end of August 2022. So the pressure really coming through. And of course, this feeds into worries about inflation and therefore interest rates. So it is something that will affect a lot of markets, really. All majors as well, notably Exxon doing particularly well yesterday. So there are some positives if you're looking purely at stocks for the rise in oil prices. But once again, this consolidation in oil has resolved to the upside, as we should usually assume it would, I think, really. Stochastics and MACD moving higher once again. Buyers firmly in control. Any hope of a more short-term, deeper short-term pullback has been cancelled out with a rally back above $89 a barrel. So the buyers firmly in charge in this one as well. And potentially now, for the longer term, we have to draw a new line. We're looking down towards the late August highs, 97.55. And given the speed with which we took out the previous highs, that's definitely one to watch for. And of course, inevitably calls for $100 a barrel oil coming back round like clockwork. And to take advantage, of course, the price continues to rise. So the buyer's firmly in charge on this one as well. And with the moving averages all curving higher now, it remains to be the case that dips are more likely to be buying opportunities rather than to turn into something more substantial. And so for the rest of the day, it's a fairly weak start for European markets. US futures pointing lower as well. We expect the Dow to open around about 33,510, and that's down about 50 points from yesterday's close, really coming into quite a bit of pressure there, really. We do have US weekly jobs claims as normal today and pending home sales. We've also got a speech from Powell at 9 p.m, but that's not expected to be particularly exciting, so it might move the market. We do have before then at 4:30, expected at 4:30 UK time, is a vote in the Senate on that US government shutdown designed to provide the short-term funding to stave off a shutdown of the US government. That will be voted on in the Senate first and then will pass to the House. And expectations relatively solid that that will actually get done. So that is providing some modicum of support to risk appetite, although you'd be forgiven for trying and failing to see it so far in trading this morning. That's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.